trade today. So here's the first tick on the index coming through in second, 20 points lower on the Nifty, down about 0.1%. So you'd have to say largely flat, no great move on the upside. The mid-cap index is also flat with a bit of a positive bias there. L&T is really the stock that's taking a beating this morning, 3% low on L&T. I think the fact that the operational performance is weak has overshadowed the higher guidance from the company. So L&T is down about 3% odd. You have Axis Bank, ICICI Bank, HDFC Bank. The Bank Nifty is actually dragging its feet a bit this morning. So don't lose sight of that. 200 points low on the Bank Nifty. Infosys, Reliance, or other heavyweights are also dragging at this moment. On the upside though, NTPC is up about 1.5%, Divi's Labs is up about 1%, Tata Motors, Nestle, UPL, Coal India, Adani Ports are a couple of other stocks that are trending in the green right now. ITC is also holding up, and so is Asian Paints. Not too bad over there. But otherwise, you'd have to say it's a very quiet opening, especially for the frontliners. All the action really is in the broader markets. But some stocks that are hitting fresh 52-week highs as well. PB Fintech, by the way, is at a fresh 52-week high, so don't lose sight of that. And many others from the large caps as well, sitting at fresh 52-week highs. But the mid-cap index is outperforming.
Well, that's right, Sonia. And a couple of big winners actually from the broader markets. You mentioned Kochi Shipyard. Also pull up Piramal Pharma. That stock's up close to 6.5%. Second consecutive quarter where they have maintained their margins. On a year-on-year basis, it looks very good. The street likes it. The stock is up close to around 6.5%. IRB Infra is taking a bit of a breather. Last few days, it's been running big time. In fact, in this month so far, it was up close to around 30%. Now it's pulling back close to around 3% in trade today. A few more notable big movers. Mahindra & Mahindra Financial. Well, the street believes that the numbers look pretty good. So that stock's flying away. Jamna Auto is another stock that's up close to around 2.5% in trade. IREDA, that's another stock that's up and about in today's trading session. What's under pressure? Voltas, that opened up with a cut of around 2%, I think, but it's cut some of its losses. Now it's on the verge actually of moving into the green. So that's one stock that's in focus. India Bulls Housing Finance is up close to around 2.5%. Big up move is what we're seeing out there. And some follow-through move even on KPIT Technologies. There was some fear that maybe the numbers won't be too good. The street likes the numbers. Street likes what they have to say in terms of an outlook as well. And that explains why that stock is up close to around 2% in trade today, building on yesterday's 3.5% gain. Prashant.
Okay, well, so it's a 40-point lower start, 50-point lower start. 21,475 is where we are starting the day at. And the big one on the downside is, of course, as we said, L&T, which is now down a full 5%. So that's coming through with large cut. And, of course, IRB is down about 5% as well right now. You know, Kirloskar Electric was a stock which shot up in the last 60 minutes yesterday. It's seeing about 3.5–4% pullback. That is KECL. Yeah, that's one. So at about 145 right now. VIP is down about 2%. It's just opening up. Indus Tower is down about 2. Trent is down about 1.5. Rain Industries, which had a sharp move and saw some profit booking, is down again this morning with about a 1% lower start as well. On the upside, apart from what we mentioned, Azad Engineering, you know, there's news there as well. 6% higher on Azad Engineering. The only reason I'm mentioning that is because volumes are the third highest on the NSE right now. It's at about 906, 907, 6% pop. That's a really large one. There is Zentech, which is about 5% higher, 840. M&M Finance is up 4%. M&M Finance started slow and then has picked up pace quite a bit. There is KEC, which is up about 4%, reacting to number 654 or so. There is Keynes Technologies, which is up about 4%. EMS Limited is another one which starts about 4–5% higher. I'm not sure these are individual result reactions or just a broad move before the budget, because a lot of the focus has been on sort of making in India, what else can be done there, etc., etc. Essentially, the expectation is that more items would be included, at least the intent would be shared tomorrow. Well, UTI AMC saw a 10% move yesterday. It's up about 3–3.5% right now. So yeah, I mean, this is looking good. Policy Bazaar, which started sharply higher. It opened at about 959. It surged to about 1,023. About a 60–70 rupee move after the open. It's cooled off a little bit. So it's trading now at about 983 or so. So that's the overall picture that we have on our hands. Sorry?
I just want to make one mention on PB Fintech. Okay, it's flashing actually on the screen. PB Fintech has now crossed the IPO price of 980 rupees. So that's a big mover today. Of course, very good numbers. Reported profits for the first time and that is a net profit for the first time, and operational performance has also picked up significantly, and now it's crossed the IPO price as well. So big moves coming.
Some of those investors had to see half the price as well at one point of time, and it's seen a good recovery from there. So they'll be breathing quite well today.
Right, no, absolutely. You know, a rising boat lifting all tides. And of course, I mean, PB Fintech itself is, as Sonia mentioned, done well. I mean, it's much needed improvement coming through in numbers, etc. Out there as well. Let's welcome in our market master of the day. Mihir Vora is now joining us, Chief Investment Officer, Trust Mutual Fund. Mihir is in our studios. Mihir, great to have you with us here. Thank you very much for your time. Let's just start with just that, which is Policy Bazaar, PB Fintech. What are your thoughts?
See, I can't comment on specific stocks, but in general, you know, the fact that there are now companies in specific new age or new tech segments, which are B2C, these are companies which have now created some kind of a moat in terms of their niche. So whether it's in the B2C retailing space or B2C financial space, we have other examples where B2C companies which have millions of subscribers are now cross-selling loans, etc. So this network effect and the first mover advantage is leading to a lot of value creation in some of these new age companies. So we've been discussing this for the last couple of years. We were not comfortable when a lot of these value IPOs came in 2022. So we did not participate in that. But last year we started participating when the valuations corrected. It was only a question of valuations. Nobody was questioning the fact that these business models are unique and they have a moat. And in most of the segments, it's going to be a winner-take-all kind of a situation. So maybe you'll have 1 or 2 or 3 players max in each of these niche segments. And I think now we are beginning to see the benefits of some of these.
Okay, by the way, I want to mention that the all-time high for PB Fintech was 1470, right? So it's still off 50% from its peak. I mean, people have lost and gained money in this one. So, well, we'll keep tracking that for you, PB Fintech. But how are you feeling about the markets? I want to start with L&T actually. You may not want to comment on individual stocks, but you know, there is operational weakness in L&T, but the order inflow guidance is very strong. As an investor, do you use this as an opportunity to buy into names like L&T, or are you cautious?
No, certainly. Infra and construction and capital goods, the investments theme continues to remain, you know, very robust. I don't think there's any change in that. But, you know, the markets have run a bit fast and you are seeing these +7, -7 in any kind of result, right? If it's a disappointment, it's a -7%. If it's a surprise, it's a +7. So I think the markets are a bit stretched in some of these segments, and you can see some, you know, sharp reactions. We've seen in some of the financials also, sharp reactions on a little bit of disappointment. So I think this is natural at this level of the market. I don't think the structural thesis has changed.
All right. What about pharma, Mihir? You know, that started this year actually very well. One of the best. Dr. Reddy's numbers started a little bit subdued. The stock is well in the green. It's one of the top gainers. Now it's up close to 2%. Your Pyramid Pharma, the rank underperformer, suddenly that one as well has popped up in trade. What are you making of the pharma space? Is the worst of pricing erosion behind? Are things going to pick up from here on?
Absolutely. We've been talking about this, you know, that pharma is one sector which probably is way below its all-time highs. I mean, it's underperformed for almost 5 to 7 years. So I think there was a lot of catching up to be done in pharma, which is now happening. Plus, we had the spate of FDA, you can say, inspections, which had some negative news in some of the stocks. But I think we are all past that. And the fact that some of the largest generic companies in the world are facing financial stress means that these level of generic drug prices are no longer sustainable. So Indian companies were anyway one of the most efficient and cost-effective manufacturers of generic bulk drugs and generic formulations. So I think they'll be the last one standing, and this is what's happening.
Anything from the budget tomorrow, Mir?
Budget, the key thing to watch is whether they continue the capex push. Last 3 years, we have seen revenue expenditure growth of just about 3%. And capex growth of almost 30%, and that's what's creating a lot of the excitement in some of the capex names, construction names, which has been sustaining the market. The fact that this is an election year may veer a bit more towards subsidies and revenue expenditure. So whether it comes at the cost of capital expenditure is something that needs to be seen.
Okay. Well, I just want to point out that for the market, it's a little bit under pressure right now. So down about 50 odd points, but the mid-cap space is really surging. So there's plenty that's moving around over there. A couple of these names, Piramal Pharma is up, 3.5%. M&M Financial is up almost about 3 odd percent. Post its numbers, and Tata Motors ahead of its earnings has been just hitting new highs. The entire auto space is expected to do pretty well this time around. Tata Motors has been, I think it's almost doubled in the last 1 year. At this price, is the risk reward still favorable for names like these?
See, I'm more bullish on the domestic economy and the domestic consumer demand. So some of the names where you have international demand, international operations are far bigger. It's difficult to take a call. But having said that, auto in general is another sector like pharma, which did not do much even compared to the pre-COVID levels. So my guess is that auto, pharma, these are segments which are still, in terms of the size of the industry, size of volume growth, far away from what their potential long-term growth rate is, and they have a longer runway, I would say, in this.
In the last 3 years, Sonia, Tata Motors stock is up close to around 10 times from those lows. So if someone wanted to buy a Jaguar, they said, let's buy the stock, let's take a punt in there.
It reminds me of that story of Eicher Motors, right? When it went, I remember at one point it was at 8,000 rupees and it went to the high then in the next 1.5 2 years, and Eicher Motors was 22,000. And at that point people said, if you'd bought the stock rather than the bike, today you would be sitting in a Jaguar.
It's all timing, right? If you bought it in 2017, if you bought that Jaguar, you would at least have the Jaguar, but if you bought the stock, you would be sitting 1/4 of the stock price. But if you bought it in 2020, you'd be saying, yeah, it's up close to around 10 times. So that's, it depends on when you get it.
Yeah.
Absolutely. But Amir, tell us about the banking space. We got into this year, everyone was saying, wow, this is going to be the year for the banking names. Valuations in line, you have earnings visibility as well in there. And everything else may falter, but this one will hold one end up. It's actually been the reverse so far because of the big boy HDFC Bank.
Absolutely.
How would you approach the space between private and public sector banks?
You're right. It's been a disappointment, and so far it's not about asset quality. Of course, RBI did point out that they are a little bit concerned on the unsecured lending part. So that is something that is a smaller portion of the overall pie. I would not say that could create concerns for the entire banking sector for asset quality. So the concerns are mostly on the margins, and that I think is a function of the fact that RBI has kept liquidity tighter longer than what was expected to be.
Yeah.
You're seeing consistent, liquidity tightness and the corresponding hike in deposit rates. There's a scramble for deposits, and as you said, the big bank wants to fix its asset liability for the longer term. So this is creating a lot of pressure on the funding part. I don't think it's about asset quality. It's all about the funding part, which is probably in the hands of the RBI to fix. And I think the way we are positioned as government spending starts again in the run up to the elections, we should see some liquidity coming back into the system and some pressure easing off.
Okay, just on that point we were making about, stocks to buy rather than buying vehicles. Someone's messaged me saying that they won't buy a Mercedes, but they'd rather buy landmark cars because, that's the stock that deals
premiumization theme playing out there.
Premiumization theme, and maybe, in a couple of years, they can just buy their own plane. I don't know how things are going to go from here. But Mir, coming back to the here and the now, right? One theme I wanted to talk about was technology, because, companies like KPIT Tech, companies that are doing a lot of work in AI, in generative AI, are doing pretty well right now. KPIT Tech just yesterday spoke about how they're very confident of achieving their full year guidance, the raised guidance. So what do you do in a space like this? Which are the companies to pick and which are the ones to avoid?
So in tech, I think there is a clear difference between the large names and some of the specific mid-cap names. And that's what's playing out. The specific mid-cap names have niches which they are able to exploit, and they are still too small, so small that they can continue to grow at a superior rate in those niche segments also. The larger companies are having a problem in the sense that they are so big that incrementally to gather that order book for 10 to 15% growth is becoming, a bit of a challenge. So I would be very stock specific in the IT sector, and there is a lot of exciting work happening in the mid-cap space, I would say.
All right, maybe we'll leave it there. Thank you so much for joining us. Great conversation as always, and thank you for coming in on short notice. Thank you. Well, it's Mihir Vora with a view on markets and how things are looking. Well, let's just take a quick look at where the index is at. We are at 21,500, which means that there has been a sharp pullback from the day's lowest point. The market, I think, was down almost at about 21,448. We've pulled up about 50-60 points from that level, almost back in the green now as far as the Nifty is concerned. Pull up this stock, Azad Engineering. I think the news was, and I just looked up, by the way, it's moved up to being the top volume gainer across the NSE. They've won a contract from Rolls-Royce to make, engine parts Rolls-Royce makes aircraft engines, and they've won a contract on the defense side to make aircraft engines. So that's the big one, which is moving up. Let's talk about, actually, I don't think we've ever mentioned this right at the word go in the first 10-15 minutes, but there you have it, a completely new name. And in the last 2 days, it's up about 37-38%. That's the kind of move that we've been, those are the kind of moves we've been having. The other one, for example, is Shakti Pumps, right? I think 40% in 2 days, and today it's seeing a small cool off. The last I checked, it was down about 1.5-2% or so. So not lacking for excitement, not lacking for large moves in this market at all. Even though the Nifty it's actually turned into the green now after being down 70 points, 21,522. But we've got the first management with us. Nigel, take it away.
Well, let's focus on Blue Star. The numbers were rather strong for the company. Record revenue growth, healthy margin expansion as well. We have with us Mr. Advani, the Managing Director of Blue Star, who joins us on the show. Hi, Mr. Advani. Good morning, and thanks so much for joining in. And first of all, congratulations on a very, very good showing. I was just looking at your Q3 numbers and comparing it with some of the peers. You have grown in style. You've grown close to around 36%, which is much better. Even for the first 9 months, you've grown much better. This I'm talking about in the RAC segment. And you've been telling us that that target is to get to market share of around 15%. Could you tell us what is the updated number? By the looks of it, you've gained quite a lot of market share. And do you think you're closer to that 15% odd mark?
Great. Thank you so much for having me. Appreciate it. Let me just talk about the overall numbers, and then I'll come to the room AC business. So revenue grew 25% in the quarter, as you said, aided by our segment 2, which is both room air conditioners and commercial refrigeration, which grew at 35%. EBITDA was very positive. We got to 155 crores, which is about a 48-50% growth. And PBT, we were able to deliver 134 crores. Actually, this is the first time in the third quarter, which you know is usually a slow quarter for Blue Star, that we were able to cross a PAT of 100 crores. So I think we're headed in the right direction. Coming to the room air conditioner business that you talked about, you're right, we had a very strong quarter. Of course, revenue did grow 35%, so we have improved our market share slightly. I think about 13.75% is our estimate. I do want to say that the industry has done well. So, of course, we've done slightly better than the industry, but overall industry has been very strong. You know that it was a weak summer, and I'm very happy to say that we've come back strong after a very poor summer. So I think a lot of it is sort of pent-up demand that was not fulfilled in that period, which has come in Q3. Margins also, we were able to hold a slight drop from last year, 7.4% to 7.1%. But I think that we had anticipated because comparative conditions are, of course, quite extreme. But I think overall, a very well-delivered quarter for us. Thank you.
Okay. All right. Mr. Advani, I had a couple of questions on the margins then. The EMP business margins, that looked very, very good. Was there any one-off in that one? Point number one. And point number two, on the unitary products business, the growth was good, but operating leverage didn't really play out. Could you explain that to us?
Sure. So in segment 1, you saw profitability grow from 7.1% to 8.2%. I think that's what you're referring to. Revenue growth was also reasonably strong, about 18% to 1,182 crores. So that was not anything one-off. I think all our businesses in segment 1 have delivered, whether it's our projects business. We had a very strong quarter for commercial air conditioning. We're very happy with the progress we're making there on the product front. Of course, our international businesses are a little smaller right now and will take more time to deliver results maybe in FY 25-26. Our service business continues to be very stable. So I think all around, a lot of focus on cost management, and we did get operating leverage there. Segment 2, you have pointed out rightly that operating margins were at about 7.1%, slightly lower than same time last year. So on the positive side, we've had stable raw material costs. We've had stable foreign exchange. We've been working very hard to take out costs from our products and bring better priced and lower priced products to the market without affecting our margins. So I think that we could have done a little better, I agree. But I think what we're keen to do is to see that we were able to load all our channels appropriately for what we expect is going to be a very strong summer. And therefore, we did have to compromise a little bit on pricing. But I think looking forward, we continue to be positive on operating leverage and delivering a far better operating profit for all our segments.
Okay, so can you give us the blended margins? What would the blended margins be by the end of FY25?
So we've been indicating that we want to get close to 8.5 to 9% in segment 2. I think we should be able to deliver about 8.5. Q4, as you know, tends to be a big quarter, both in volume as well as in profitability. And so far, the outlook for the industry is very, very strong. We're well poised, so I think we should be able to deliver that number.
No, so 8.5% you said in segment 2.
Yes.
I'm trying to understand overall. I mean, what would it be?
Oh, overall, so yeah, we have a lot of moving parts over the next couple of months. We've been indicating that, we want to see EBITDA go across that 7% threshold and then start inching up 7.5%, 8%. So we're on that track. I'm a little unclear right now how we're going to end the year in aggregate basis, but we hope to cross that 7% if things go well.
Mr. Advani, hi, morning. Can you talk to us a little bit about what is the situation as far as competitive intensity is concerned in the RAC market? Because that picked up immensely over the last couple of years, right?
Yeah.
So how's that looking now?
So, we've been talking about it with you for several quarters now. There's a lot of production coming online because of the PLI. Of course, our plant was commissioned first out of all the PLI investments, so we got online early. But we've had a number of competitors who have commissioned plants over the last few months. We expect more to commission over the next few quarters. So certainly there's going to be competitive pressure increasing. Our focus, as you know, it's actually quite simple. We focus on product development. We're trying to take out costs so that we have products that are priced correctly. We've traditionally been a premium player. We've come down to affordable premium. This year, whatever results you're seeing are largely delivered by our affordable product range. So what we've been conveying over the last few years is that as we bring down price points, we will do so without foregoing our operating margins, and we're showing you that. So I think we're executing a fairly tight plan. We are commissioning phase 2 of Sri City by March 31. That will increase our own capacity substantially, as well as for exports. So we are very much on our CapEx roadmap that we have planned, R&D investment, digitalization investments that we've talked to you about. And we think that in spite of the competitive intensity, we should be able to deliver the growth and the profitability numbers. I think what is...
Mr. Advani, I get that, but there'll be no pricing-led growth in that sense, right? For the next couple of years, I would imagine.
No, we're not seeing a lot of price leverage there. So it is all about cost and how efficiently all of us can deliver.
Okay, well, you mentioned growth quite a few times with new capacities coming on stream. Give us a growth number. For FY25, what kind of a growth number should we look at? Very quickly, sir.
So 20% plus is what we planned to deliver. Top line and hopefully bottom line better than that.
Okay, 20% plus. Got it. Thanks a lot for joining in. Appreciate your thoughts here. We'll take a quick break. When we come back, the big mover in trade PB FinTech. We'll discuss their third quarter earnings. Stay tuned. Welcome back to Corporate Radar on CNBC-TV18. The big stock of the moment is PB Fintech. The stock is up almost 10%, and it's after reporting a good set of numbers. First quarter that the company has turned profitable on the bottom line, that is the net profits, and also operational performance of PB Fintech has improved. It's a high base, remember, and despite that, it's a strong growth that the company has seen. Now, it's sitting at a fresh 52-week high right now. I think it's back at the IPO price. Okay, it's not a 52-week high. It's back at the IPO price. Okay, 1,019. But I think still a little bit off the... it's gaining by the minute. When I tracked it last, it was at about 950 or so, now 1,020. All right, let's get to the management and talk about the business. The total revenues are up 43%. Contribution margins are up 400 basis points. Yashish Dahiya, who's the Chairman and Chief Executive Officer, and Alok Bansal, the co-founder and Executive Vice Chairman, join us now to talk about their Q3 performance. Gentlemen, morning to both of you, and thank you for joining us. Mr. Dahiya, I want to start with asking you about the business itself. If you can just tell us, the next quarter is expected to be the strongest quarter seasonally. So in terms of premium generation, credit disbursals, what are you expecting? Can you share some numbers with us? And, what is the overall growth looking like? What do you see as the big triggers over the next 1 to 2 years?
First of all, thank you very much for having us here. I think let's just look at it with a little bit of time in perspective. Let's look at, 3 years. We went public in 2022, and thus, if you look at the numbers of 2021, which is the back of the numbers on which we went public, 2021, our revenue was about 800 crores. In the last quarter alone, our revenue was 871 crores. And if you look at the, year, we will probably be at about 3,600 crores, right? That is 4.4 times what we were exactly 3 years ago. Now, I think that is what is critical. When you look at digital businesses and how they are growing, specifically once they gather steam, they start to grow quite rapidly. And we've been growing at scale. When we went public, we were not entirely small, right? We were quite okay. So as you look at the next 3 years, what should our growth rate be? If we've grown 4.4x in the last 3 years, maybe we'll be about 2.5x. Maybe it's 2.3x. But saying we'll be anything less than, let's say, 2x would seem kind of terrible, right? So I think 30+% growth rate should be pretty standard for us for the next 6-7 years. Now, when you look at the macro trends, India growing, young people, nuclearization of families, insurance under penetration, the health and term products that we focus on, the nominal GDP of India anyways growing at 12 to 15%, right? Again, a 30% growth does not seem like a lot.
So
a base industry which itself is growing at 10-15%, growing at double of the industry does not seem like a lot.
Got it.
And,
yeah. Mr. Dahiya, if you're talking about a 30% growth, right, I understand that you're also interested in some new areas of business, whether it's in the payment space, whether it's in the insurance space. Can you tell us what are those new areas that you're looking at over the next 1 to 2 years, which could perhaps aid this growth further?
I want to be crystal clear so there's no confusion. We're not looking at new areas. We are only looking to strengthen our current offering, deepen our current offering. Ever since we've started, we've continued to deepen our current offering, our then offering. And this is just a progress into being able to control more and more of our customer experience. And that is essential because, and I think that is why scale is important. As we get scale and we have good quality of business, we add value to our partners and they can cooperate more with us in allowing us to provide better customer service to our customers. What does that customer service mean? It means better customer support, better claims assistance, better... and what does control mean? Control means having more and more data points, having access to more and more, payment mechanisms, etc., being able to give more flexibility to our customers. All of those things we would like to build out. When we talk about our reinsurance brokerage project, what does it mean? It means being able to create better products for our consumers. And I think each one of these is just about strengthening the current business. I doubt if we would do anything outside of our existing business lines. We don't have any such plans.
Okay. All right, gentlemen, good morning. Great to have both of you here. And I hope we can make this a quarterly feature. And congratulations. I mean, I think to you and, of course, a lot of the shareholders who've seen the price, large price swings. Mr. Daya, if I can start with you. So 30% growth, you're saying, for the next several years on the top line is doable?
We would be very disappointed if that did not happen.
If you don't do that. Yeah. So that's you're saying, so in that sense, 30% is, you're describing it as a conservative kind of a way to look at it. Yeah.
Yeah, I would say that's par for the course. We would expect that to happen.
At the bottom line level, at a profit level, what should we expect on a CAGR basis for the next several years?
Bottom line, we haven't reached a point where you can look at CAGR and explain why. See, we have, every time we make 1 rupee of revenue, roughly 30 paise, after taking care of fixed costs, etc., flows to the bottom line. I'm talking about profit, right? So if we are growing at 30%, let's say, that automatically means roughly, 9% of our total revenue is starting the flow line. Now, that is a great way to think about how the profits would move, because the profits are moving on the base of the revenue, right? So incrementally, 6-7% every year for the next coming few years are flowing in additionally to the bottom line. And that is why the EBITDA margins will improve very rapidly. So there is no point looking at a growth rate, because this year we would probably do maybe 60-70 crores of profit. But if you look at the same business 3 years from now, we have guided that it would be about 1,000 crores of profit. So I don't think you can look at a growth rate yet. I think the important part is when the 1,000 crores is done, the profit part would still be growing at about 60% every year. So I think that is when we can start looking at PAT growth rates or PBT growth rates.
Okay. All right. Good morning, gentlemen. Nigel on this side. I recall we had a chat a couple of quarters ago and you all were very confident about turning things around. And the street has appreciated this performance. Now, this 1,000 crores of PAT, it comes in 2027, right? That's the guidance that you all had given.
Yes.
Okay. I had a two-part question on this. Your new initiative business, by when does it turn EBITDA adjusted positive? Point number one. And also, how does the ESOP cost come down? A couple of years ago, I think, or last year, it was around 600 crores, which is gradually expected to come down. So tell us about that.
So I think we don't have any immediate plans of breaking even on the new initiatives. The costs have been coming down gradually, and they will come down gradually. I think within the next 3 years, they should become break even. So by 2027, we hope that the new initiatives part is close to break even or irrelevant in the big scheme of things from either a profit or a loss standpoint. The ESOPs were awarded over a 5-year period. They were equal amount every year, but the way they get charged out is 45% of the 5-year ESOP pool gets charged in the first year, then 25%, then 15%, then 9%, and then 4%. So what that means is every year you see a lower and lower ESOP charge. So we were heavily penalized around the point of time of IPO, and we pointed this out that it is looking this way. But of course, that's the way it works.
Got it. Let's also get Alok Bansal into the conversation. He's been waiting by patiently. Alok, on Paisabazaar, I wanted to know, the RBI came out with the recent guidelines on unsecured loans. Has it or will it have any kind of impact on Paisabazaar's business?
It's got some minimal impact, to be honest. I think our focus in Paisabazaar has been on unsecured lending, but not at a very, very low ticket size. Our average lending is about 3 lakh rupees per loan. So we do not see a huge amount of impact per se, but from suppliers' perspective, yes, they have become a little bit more cautious, and we are trying to work with more and more suppliers. So for the very short term, which is like this month and maybe next couple of months, there will be a small dip in the growth rate. So if we were growing at, say, X percentage, we may grow at 10% lower. But we don't really see it as a long-term weakness in the business model.
So can you tell me what that number is? What is Paisabazaar's growth right now? Say for the full year FY25, what are you penciling in? And if you're saying that there could be an impact, how much would you want to scale down your guidance?
So there's no change in the guidance, and it's not about FY25. I mean, for FY24, overall, it will still grow at more than 30%. It's just that, yeah, it would have grown maybe near 40%. Now it may grow more about 32%.
Mr. Daya, Bima Sugam, every time we talk to you, that comes up. So that is now kind of part of the calculations in terms of how that may or may not kind of scale and what may happen there?
Our objective is not just Policy Bazaar growing. Our objective is insurance in India should grow. And I think any government effort in making that grow will be fantastic. I think increasingly what I understand is Bima Sugam is going to make life easier for everybody, including us. Right?
Okay.
So I think it would help the entire industry grow. And whether it's ONDC, Bima Sugam, all of these are efforts that make the industry grow. And I think that would make all of us more successful at being able to give confidence to the consumer in buying more insurance.
All right. I mean, the way I see it, when it first came, it seemed, because it was a new concept, it looked like a bit of a threat. But as time has passed by, and I guess industry consultations, etc., have also happened, you're more sanguine about the role that would play. I don't know if I'm paraphrasing it correctly, but that's what it seems like. But in any case, thank you very much. Is that correct? You're smiling, Mr. Daya?
No, I usually smile because there's a particular characteristic of me. I don't forget everything I have said and whatever I believe. And the thing is, as times change, people start realizing what I was saying was correct. And but they themselves forget that, I was saying the same thing 1 year ago or 2 years ago. It happens all. I'll give an example, right? When Info Edge invested, Hitesh told me, you should make 100 crores of revenue. So then I went back to him and said, we've made 100 crores of revenue. You asked us to make 100 crores of revenue. He said, when did I say that? So this happens all the time. So it's okay.
So, all right. So you're not worried. That's, I guess, then the way to put it, as you said. Thank you very much, Mr. Daya, for joining us.
Thank you.
Mr. Bansal, great to have you with us here on CNBC-TV18 as well. So that's PB Fintech, the stock of the day, with the very large move, 10% plus move that we have on our hands right now. KPIT Tech is the other one that we're going to focus on. The stock on the last couple of days corrected. But the performance of the third quarter has been good. Constant currency revenue growth is up both sequentially on a year-on-year basis. Deal wins are also up 20% plus in the third quarter. We have Mr. Sachin Tikekar, President and Joint Managing Director at KPIT Tech, joining us right now. Sachin, good morning. Great to have you with us here. Thanks for your time. It's been a strong quarter. So growth has come in at about 4.5% constant currency, Q on Q. But immediately, I think the question which comes to one's mind is, we just, for example, had the Tata Tech management with us. There we saw a very large ramp down by their second largest client. If you look at the largest player in the global EV ecosystem, Tesla, that is disappointed revenues. I mean, I think there is a bit of a scale down happening there, maybe temporary. So the question to you is this sustainable, the growth that you've done?
No, great question. The way we look at our business is the propulsion side, the electric vehicle part that you talked about is the propulsion part of our business, and that's the largest business. Having said that, bulk of the growth is also coming from software-defined vehicles and in-car experience and off-board services. So, all these three things put together, that's the composition of our total business. Speaking specifically about electric vehicles, there is a slowdown in growth of electric vehicles as compared to what we witnessed in 22-23. However, our business actually depends on building the production programs and not necessarily how many cars are produced at any point in time. So looking at some of the OEM commentary in the recent past, they have inventory, and they want to make sure that they get rid of the inventory. So the production level may go down for some time. However, that doesn't impact our production programs. Our production programs, working with them on electrification, typically start 3 years in advance. So we are already working on some of the production programs for the SOP year 26-27. That work continues for us, and that gives us the confidence that we'll continue to see growth in this area in the foreseeable future.
So I think what the street really liked is the fact that you said you will be able to meet your revised higher guidance for the full year. But there are some brokerages that believe that given the kind of traction that you're seeing, you could even exceed your full year guidance for FY24. Is that a possibility? And what do you think the early signs of FY25 look like in terms of growth?
Okay, let me take one question at a time. As far as this year's guidance is concerned, we revised our guidance from 28 to 30% to 37% last quarter, which is unusual for us because we just do that in quarter three. We now believe that we'll do 37% plus. So that's the confidence that we have in the current financial year. As far as the next year and beyond is concerned, we do see profitable growth coming our way, just based on the engagements that we have with our existing clients and the conversations that we are having with 2 or 3 other OEMs. So we're looking forward to exciting times ahead.
Okay. So now just one follow-up here. You know, Europe has been very strong for you, but the US revenue growth has been kind of tepid. I think it's not just the case with your own business, but a lot of your peers are speaking about that as well. Where are we in the cycle right now as far as the US growth is concerned? And what's the trajectory you're expecting?
So if you look at year-on-year growth for us in the US has been healthy. It's in excess of 20%. So we are happy. You've seen some drop in quarter, which actually depends on different programs at any point in time. US compared to Europe, you're absolutely right, has been slower for us. We do hope there have been issues in the US, as you know, with some of the strikes. OEMs have overcome those issues. We believe that there will be growth for us in the US as well going forward. There are 2 reasons for that. One is our engagement with the passenger car OEMs is looking solid in terms of the number of programs that they have and our engagements with them. And secondly, more than 20% of our business actually comes from commercial vehicles, mostly on the truck side. And we believe that US is the large contributor towards that growth. So as we get into the next financial year and the year after, we think that we'll continue to see healthy growth coming from US.
Okay, all right. Hi, Sachin. Good morning. Congratulations on a good showing. You know, your margins have improved as well, and that's something that's heartening, and that's something the street has taken note of. What are the levels you'll have in store to improve from here on? And where does it get, say, in the next 2 years or so? Point number 1. And point number 2, deal wins, yes, they're good, 21% higher in quarter 3. But year to date, actually, it's a little bit lower. What's the pipeline?
So let me take the bottom line question first, and then we'll talk about the pipeline.
The margin.
So yeah, the margins part. Margins, yes, in the last 14 quarters, we have had consistent growth in our margins. And now we always wanted to make sure that we get beyond 16% in EBIT and 20% in EBITDA. We have reached those milestones now. However, what we have done in the past is we have always reinvested more in future technologies, and that's what is really creating tremendous value for our clients. We'll double down on that part and make sure that we stay ahead of the curve in terms of our investments. We believe that there is scope for profitable growth going forward. However, the application of the additional profits would go more towards R&D in future. So if that answers your question on the margins, I'll talk a little bit about the pipeline. You're absolutely right. There is a quarter-on-quarter growth in the pipeline, and we are happy with the pipeline that we have. If you look at year on year, what has happened is we work with a handful of clients, and when we engage with them in a strategic manner, our win ratio goes up substantially. So the pipeline may look, more or less the same. However, our win ratio has gone up substantially. So that gives us confidence that we'll continue to see profitable growth in the next few years to come.
So you're satisfied with your margins, right, Sachin? Just want to confirm that. As of now, you're satisfied. The additional money that you'll get, you'll be reinvesting it.
Most of it, yes.
All right,
we are very happy with the progress that we have made, and it just gives us additional levers to continue to make investments for future.
So just to wrap it up, Sachin, one of the
Yes.
things globally which is being talked about is that as subsidies, especially on the electric side, come off, and this is happening in US, it's happening in Europe, it's happening, of course, here in India as well, right? There's a bit of a boost initially, and then subsidies taper off with every new technology. How critical is that, and will we, as that continues to happen in the next few years, will that is that a large factor for in the push, or you think we've reached a stage where it's takeoff with or without government subsidies?
You're absolutely right. I think in some countries there is a takeoff with or without subsidies. I think there are environmental reasons and there are many other reasons to go the electric way. And I think we are reaching a point where there is enough now. I think there is the prices of the electrification will continue to go down over a period of time, and the cost of the electric vehicles will also continue to go down as all the OEMs reach critical mass. So there is no turning back now on electrification. There are always, year on year, you'll always see some ups and downs in terms of the number of vehicles being sold. Last couple of years have been really good. So compared to that, I think the growth may not be as much in the next year or two. However, if you take a longer term view, as more and more technologies come in play, electrification will become more efficient, number one, and number two, also more cost effective.
Okay, all right, and that's where you come in. Thank you very much for joining us, Sachin. Great conversation. Appreciate your time here on CNBC TV18. Stocks up, I think, at the day's highest point. Last couple of days have been a little down for KPIT Tech. By the way, the market, which was up 50 points at one stage, I think we've given up some of those gains and up about 20 points. So yeah, there you go. Already within the first hour, so much has happened. We'll take a quick, what we'll do is we'll get Shrikant Chauhan in with a quick view on technicals. Shrikant is with us now. Shrikant, good morning. On the index, is there a particular trade you would advise and any stock specific ideas?
Yeah, good morning, Prashant. I think, the markets are going to spend some more time within the range of maybe 21,600 on the high side and 21,400. And most of the time ahead of the event, we see market range bound. But stock-specific activity is definitely going to rule the market. And in that case, I think oil and gas stocks are really doing well. From that space, we like Gujarat Gas, which is currently around 568, 567. The stock is consolidating, and it has spent a lot of time within the range of almost 550 on the downside and 565 on the high side. But today it is holding above the levels of 565. So from here, the stock can go to the levels of 590 or 600. It's a buy at current levels with a stop loss at 550 on the downside. And the other stock which we like is Wipro, which is around some 480 levels. The reason is because bond yield is again down from the highs, and based on that, I'm expecting some pullback in IT companies, maybe some defensive bets the market will take. Wipro looks good at current levels around 488, 489. At 480, 485 with a stop loss at 465. Again, we are expecting 510, 520 on the high side.
All right, Shrikant, we'll leave it there. Thank you very much for joining us. We'll take a quick commercial break here. Commodities up next with Manisha in just a bit.
Welcome back. As promised, we're going to get you a quick handle on what's happening in the world of commodities. Manisha Gupta is here to give us the latest on that. Manisha, over to you.
Thank you for that, Sonia. Well, even as you thought that inflation was just about easing, look at the month of January in 2024, and many agriculture commodity prices actually have started to surge. I'll start with rice futures, and we're trading at a multi-month highs onto this one, trading at an 8-month highs right now in the international markets. So the rice futures are at a May 2023 highs. There are concerns about limited supplies. Remember, India is also looking at a weaker rice production this time around and export curbs as well, and that has been keeping the international rice prices on the higher side. Take a look then at the cocoa prices, and they are trading at a 46.5-year highs. So this is almost an all-time high that you are looking at cocoa prices in the international markets. In the last 12 months, we've seen the cocoa prices gain up by almost 88%, and the last 1 week actually also has seen very strong gains coming in. It has to do with dry weather risks, and that has led to worsening of crop situation in Western Africa output. Remember, that is the major producer there, and we are looking at price premium building up because of that. Not just cocoa, the coffee prices also have continued to run up. The coffee is trading at a 4-week highs right now. We have seen strong gains in Robusta and Arabica, both of these varieties, and the prices have gained up by 7.5% in the matter of last 1 year. The other commodity I want to talk about, and that's only traded in the international markets, is orange juice prices, trading at a 5-week highs. We did see prices hit an all-time high in the previous year, and we have seen prices gain up by 57% in the past year. But when you look at the month of January itself, it has seen stronger gains. Barring edible oils, perhaps everything else has seen strong gains come back into the markets. So while cocoa prices have gained up by 13% in January so far, coffee is up by 2.5%, orange juice prices gaining up by more than 2% as well. Within the agri-commodities, the sunflower oil is the major gainer, 3% of gains onto that one. Cotton in the international markets, as the demand comes back, has gained up by 6% in this month. And the major gains clearly coming back in case of sugar as well. 14% up for the raw sugar prices in the month of January alone, with the markets anticipating that this quarter further could see further gains in agri.
Tell me what to drink, Manisha. Coffee prices are up, orange juice prices are up, and now you're saying
tea has seen some decline.
But even sugar prices are up,
Yes.
so I can't even add sugar in my tea. I think water is good for me. Thanks for joining in. Let's take a quick break on that note. On the other side, we'll be joined by Ramesh Iyer, Vice Chairman and Managing Director at Mahindra & Mahindra Financials, to discuss their Q3 earnings.
Welcome back. We are waiting for the MMFSL management, the Mahindra Finance management. The stock is up almost 4%. So important result to track. But as we wait for the management, let's talk about the other big number, which is Larsen & Toubro. That stock is reacting to its Q3 earnings, reacting a little in the red. Vivek is here to tell us why the market would be disappointed. Go ahead, Vivek.
Well, good morning. That's right. So earlier today, we had highlighted about how, despite the fact that, order inflow, for the quarter gone by has been extremely robust. Along with that, the management also in the media call yesterday told CNBC-TV18 that they have gone ahead and increased the order inflow guidance from what was earlier 12% to now over 20%. But however, what's actually been a bit of a miss has been the core margin. So the core business margin, first the company at the start of FY24 had a 9% target. After that, they trimmed it, and they expected it in the range of 8.5% to 9%. And yesterday they trimmed it further downwards, now expecting to end FY24 between 8.25 to 8.5%. This is slightly disappointing as far as the street is concerned, because the street has been anticipating that the execution of earlier, legacy projects should now come to an end. And next quarter onwards, there should be a bit of a bounce back as margins are concerned. So that has been delayed, and that is something that has caused their stock price to take a bit of a hit. However, what the management indicated was that now we are talking about the ordering activity. Domestic ordering activity next couple of quarters expected to remain subdued, given the fact that the pre-election, the election code of conduct comes in. However, they said that as far as Middle East is concerned, ordering activity continues to remain quite robust. And in fact, we did quiz them about, when they could expect this Hafania project. They said that, at this point of time, it largely depends on when Aramco decides to award that particular project. Order pipeline remains quite robust. The only blip as far as the performance is concerned has been the margin, and which is why, a lot of analysts have trimmed their EPS estimates for FY24.
Okay. Thanks a lot, Vivek. Got that, and the stock is reacting to those margins. But the one that's reacting positively is M&M. So let's talk about M&M Financial Services. Surging in trade today, up 3.75% as I speak. Q3 earnings came in above street estimates. Their asset quality has improved. Disbursements have also surged. But the management has lowered their guidance, especially on ROA, return on assets, the target of 2.5%, which they had originally said in FY25. They admit is tough to achieve. Ramesh Iyer, Vice Chairman and Managing Director at MMFSL, joins us. Good morning, Mr. Iyer. Thank you very much indeed for joining us. Well, first up, your margins actually are better than the previous quarter. Of course, lower year on year, but from 6.5 to 6.8, how did you manage that despite the rise in costs and the rise in risk weights?
No, so we had said this in the previous quarter because we had already put in some actions very clearly. One of them, of course, was to increase the lending rates to an extent, and that's come in on the new disbursements. Two, we've said that the product mix is slightly undergoing change, and high-yield products like the pre-owned vehicle is growing for us, and that would kind of to some extent improve the margin, was two. And the third was there was some fee-based income coming in through the insurance distribution, etc. And I think all three put together has added to a little increase in our margins from a 6.6 to a 6.8.
Okay. Disbursements are up very strongly quarter on quarter. You can maintain this pace. What is your expected disbursement growth or even AUM growth for that matter for the next year?
I think we've said it all through. 20-25% growth is not too difficult. The market is very positive. Sentiments are continuing to be strong. Footfall is high. The cash flows on which these markets depend, all of them are doing well, whether it's the tourism, whether it's the infrastructure, the farm cash flows have been good. So I think overall things are going pretty well for us out there. And we are very confident that maintaining this kind of a disbursement growth or an AUM growth should not be a challenge. And therefore, we are holding on to our F25, what we had committed in F22.
Okay, now, Mr. Iyer, you have to help me understand this because your disbursement growth is 11% quarter on quarter, but the AUM growth is far subdued. It's about, 2% quarter on quarter. Why is it so different? And let me tell you where I'm coming from. There was a Reserve Bank guy who had once explained to me that if disbursements grow so much, but AUM doesn't change, then probably there is evergreening. This was in another context, in another company altogether, but this worry can be there with others.
No, so let me be very clear. Ours is completely secure loan. We are a wheels business. and therefore the disbursements are for vehicle acquisition, tractor buying, etc., etc. And the rundown of the portfolio is little faster. So if you had the past portfolios which are maturing, they are little larger than, because they will be maturing in 3 years' time, 24 months, especially if you're on a pre-owned car. They are a 18 months, 24 months product. So therefore, the loans maturing are also at a faster pace, and that's why they don't add up to AUM. But as otherwise, there's absolutely nothing else. The disbursements are purely for vehicle and tractor acquisition. And then the rundown of the portfolio, which are maturing, is causing that the disbursements are higher, but AUM aren't.
Most helpful, because that would clarify, at least answer the skeptics. Okay, now let me come to the other problem that I had. Your profit has surpassed analysts' expectations because you have provided less. Now, you know, your expected credit loss of previous quarters, you have actually written back. How come you have so much confidence?
So it's not about confidence, it's about what's the reality, right? I mean, if you see our gross stage 3 numbers, they have come down. They have come down from 4.3 to 4. And the net NPAs, I mean, the net stage 3 has gone to 1.2, which was 2.4 the previous. And therefore, you get this natural benefit of it coming down. The second is, if this reducing trend is due to either repossessions or settlements, then you won't see this benefit in the P&L. But they are all purely by collection. And therefore, the account which was in stage 3, through collection, if they move to stage 2 or stage 1, then you get the provision benefits rolled back. I think that's what is causing this, and there's nothing other than that.
Okay.
So the overall collection efficiencies are pretty good in that market. And you can see month on month, we are putting out that number. We have trend all through the year upward of 95% or so, which is a very, very healthy collection efficiency given the cash flows of rural market. We have always witnessed first half goes through the pressure and the second half brings in the correction. But things seems to be changing because the infra cash flow, the tourism cash flow, which are more stable as compared to farm cash flow, is really helping that.
Okay, no, that's good to hear. But I'm not the only person getting a bit of a doubt over this, lower credit cost or lower provisioning. I see that also in a Nomura note. What they point out is that you normally measure provisions, expected credit loss as a percentage of exposure at default, right? ECL divided by EAD. Expected credit loss as a percentage of exposure at default. For you, it is now as low as 3.8. Shriram Finance has kept that at 6.2, which means they are being way more cautious than you. Would you still not say that you are being a little more, shall I say, confident?
I think we are pretty confident. You look at 1 year back, our GS3 number had gone to as high as 14%, 15%. And we had said that these are delays and not defaults. And we continuously see them come back. And you see every quarter, our GS3 numbers have continuously come down. I think the other factor to very clearly see is that the stage 2 numbers are also remain stable or come down, which means the forward flow is not happening, which is another very, very healthy news. Therefore, if you look at between stage 2, stage 3 together, they're sub 10%, which was never historically the number. And 90% of our accounts are in stage 1. Put all of these 3 things together, I think that speaks volume about the asset quality improvement.
Okay. That's very good to hear, absolutely, even for the sector as a whole. If you can see that with, the confidence and even put it in your numbers. While on that matter, just one issue, Ramesh Iyer, you all are not expressing your GNPA in the RBI format. You're using a Ind AS format. If you had used the RBI format, how different would it have been?
I think it would be probably 1% higher than where it is. So the 4 would have looked like 5.
Okay, the GNPA would look a little high.
Very important to see that the total provision that is required under the IRAC norms are lower than what we are carrying as an Ind AS provision. That's a reason we don't require to make any additional provision.
Okay, got that. Now let me come to the growth that you see, the margins that you will see in the coming quarters. How much will the cost of funds go up, considering that money is still tight and the risk weights are higher?
So fortunately, on the liquidity front, no issues. We have sufficient funds available for a company like us, AAA rated. There has been no problem whatsoever. Clearly, yes, the cost of borrowing has moved up. It gone up by another 20 basis point in this quarter. Hopefully, we expect it doesn't go up any further going forward. And we are also resorting to as many products as possible that's available for an NBFC to borrow from. And therefore, we are also managing it well through the mix of funds. And most of our assets also qualify for the PSL borrowing. So therefore, we get some rate benefit if we resort to the PSL borrowing, which we have been doing. Putting all of this together, clearly the cost of borrowing, if you recall our past discussion, we were expecting around the festival time, the rates would come down, but that was not true. And then it continues to remain, and therefore we are not able to make a statement about when will the rates come down, but we are hopeful it has to come down in F25. And that is something that we will wait for the further margin improvement. But at this stage, the rates do remain elevated. And that's a fact. And that's a reason our borrowing costs, lending rates have also gone up by at least 20-25 basis point.
Okay. And therefore, your guidance for margins would be?
So we think that by March, our aim is to move it towards 7. Our commitment, if you recall, F22 that we made for F25 was to reach 7.5. I think that looks a little distance away. We may be 7.2 or so once the borrowing cost comes down. I think what we have to do in terms of product mix in our borrowing, what we have to do in terms of lending rate increase, or what we have to do in terms of product mix change in our product lending products, I think we have done most of it. Now, if for it to go beyond 7, we would expect that even the borrowing cost has to come down, and we do hope it happens in F25.
Oh, yes, we all hope that, but it's simply not happening. Banks are simply competing for deposits at a higher rate. Mr. Iyer, where do you see demand? I mean, you're quite confident about the AUM growth, the clip at about 20%. You yourself in your numbers show that tractor demand is not very good. Shriram Finance in their numbers showed that personal vehicles was not very good. Like you, they've done extremely well in commercial vehicles. So if personal vehicles and PVs and tractors slow down, do you foresee any problem? Is 20 a tough target in FY25?
One is, of course, I'm expecting that OEMs will also push up the price in FY25. So for the same volume, the disbursements could be better. I hope 2 or 3% gets contributed in a AUM growth through the price increase to vehicles happen. But I think as far as tractor is concerned, I